and gentlemen, this is Rasha. Those were the headlines. And over the next 30 minutes, we'll take you through the top stories we're tracking this hour, beginning with, of course, some data, global data coming in as far as US CPI is concerned. In fact, it has shown that inflation has eased slightly in April, providing at least a bit of relief for consumers while still holding above levels that would suggest a cut in interest rates is imminent. The CPI increased from 0.3% from March. In fact, on a 12-month basis, however, the CPI increased 3.4%, which is pretty much in line with expectations, including food and energy. The key core inflation reading came in at 3.6% on an annualized basis. The core 12-month inflation reading was the lowest since April 2021. And to discuss this further, I'm now joined by Manish Singh. He's a market expert. Manish, thanks very much for joining us this evening. I want to first take you to what Fed Chair Jerome Powell said. He said that inflation has been higher than thought, and with the current numbers, in fact, though cooling off only marginally, a rate cut looks unlikely, right? And how long, then the question is, how long will this pause go on for?
Well, if you look at the inflation number today, and yes, you said on 12-month basis it is 3.6%, and if you look on a 3-month basis, it is 4.1%, which is lower than 4.5%, which was in March. So the trend has been very clear that the inflation is getting lower, and the market is now pricing in 2 rate cut for this year. And my view has not changed that we are going to see 3 rate cuts this year. And just as we got the inflation number, we also got the US retail sales number, which was negative, and the Empire manufacturing confidence number as well, which is also not very, very positive. So if you look at the set of data that we have received so far for the month of April, majority of them are trending down, or let's say below expectation. And that makes me feel that not just Fed is going to cut the rates soon, but even the market will come around to accept that, because Fed clearly wants to prevent a scenario where the rates are so tight that it eventually has to cut with at a higher magnitude, because that will be the failure on their part. They do not really want to go down to what happened in the past, so they would look to preempt it. And now this data is pointing in that direction. If you have one more data, then we will have a rate cut by July. That's my base case.
I want to understand, is inflation going forward going to be more persistent? And by when could the figure come into the Fed's comfort range of 2%?
So if you look at the breakdown of this inflation number, almost 70% of the inflation you have seen in this data comes from housing and car insurance. Now, housing, or the owner equivalent rent, OER, several measures have indicated that that's a lagging indicator. If you look at the real-time data of where the rents are in the US and US market, they're not as high as what the CPI number indicates. And this is something Chairman Powell has pointed out. This is borne by data in real time from other sources. So as that comes down, you're going to see the CPI number come down as well. But let's not think only in terms of when it goes to 2%, because if we wait for that long, we might end up having a recession. And this is something that Chairman Powell has been very insistent on. If you see his remarks from yesterday, the PPI number came a bit stronger, but he has ruled out any rate increase because he's looking at several other indicators, which does not point out that the numbers are going to be hot and he will be getting ready to cut rates. Now, clearly, given the background of what happened in 1970s, and that is something that everyone likes to take note of, that you should not have a second spike in inflation. He's mindful of that. But the data, from where I see, I think data is slowing down, and Fed is comfortable in that. Even at the FOMC meeting last 2 weeks ago, I think all the journalists were trying to be very hawkish, and he didn't take that tone. So that just points out to me that he is getting ready to cut rates. And as I said just now, I think that July could be the time when you see the first rate cut.
The time when the first rate cut could happen. Manish, in fact, some of the experts have also been factoring in that by September, that rate cut figure could come in. But could it also be attributed to elections which are around the corner? And if inflation remains sticky, it will deteriorate economic conditions, and it could very well become an election issue as well.
Yeah, so again, this question was asked of Chairman Powell at the press conference as well, and he just steered clear of it. And in fact, he categorically said that it has never been in Fed's history that they have taken an election into account. So I would think that he will be focused on data. He is focused on data. And on the balance, when I look at, let's say there are 5 broad category of indicators in which there are 8 data points in each. So far in April, we have seen almost 15 data points come out of that, let's say 35 to 40 indicators. And of that, 12 have been below expectation. So I continue to believe that we are going to see data moving in that direction. Of course, I'm not saying we are going to see a recession because GDP growth is 1.8%. The net immigration number in the US is high, as we have seen from the CBO data. So economically, we are fine. But if we leave it too late, then we will get a recession. So that's something Fed wants to avoid. And I don't think that he will be concerned about cutting rates close to election. It should not be the factor, in my opinion.
And let's also now understand from you the impact on Indian markets, considering that the VIX has been spiking for some time now. So how is this data that's coming likely to shape India's rate cut trajectory? Will it have a bearing? If you could just give us some perspective on that as well.
So I think the strong dollar has been a big driver of many things, right? If you look on the market basis, strong dollar has an impact on global growth. Strong dollar has an impact of what happens in the emerging market. So on relative basis, when the US rate starts coming down, you are going to see that fear of dollar or fear of strong dollar dissipate. Now, what we do not want is a US recession, and that's not my base case scenario. So any easing on part of the US and Federal Reserve will clearly lead to more risk-on scenario. And that risk-on scenario will continue if we are not going to see a recession. Now, given the headroom that Fed has, because rates are at 5.25, they do have a lot of headroom to stimulate the economy should it be required. My base case is that once the rate cut starts, it will probably go all the way down to 3.5 by mid next year or Q3 next year. And in my opinion, that should be enough to stimulate the economy to avert any oncoming recession. So you could have a steady risk-on scenario throughout over next 6 to 12 months. And if you're making your trades based on 6 to 12 months as I do, then you don't have to be concerned about what is happening in the short term.
That's the word coming in from Manish. Thank you very much for joining us with your perspectives. Nothing to fear, at least as far as the short term is concerned. In fact, the next few months are concerned. Manish over there, of course, sharing his views on what to make of the CPI, US CPI inflation data that's just come in. And now,
if you like this video, then like, share and subscribe to ET Now.